Welcome, everybody, to the Tuesday edition of the Not Your Average Investor Show. Today, we are finding ourselves a hidden 10K in returns. It's more than 10K, spoiler alert. It's a case study in buy versus hold, something that a lot of folks, maybe you, have been thinking about based on these crazy market dynamics. You're striking when the iron's hot. And right now, I feel an appetite for going live on Facebook for the Tuesday edition of the Not Your Average Investor Show. I am your host, Pablo Gonzalez. With me, as always, the man that I affectionately call GC because he's got genius concepts, because he generates cash flows, because he's a great co-host, and because at birth he was named Greg Cohen. Say hello, Greg.
Hello, everybody. Great to be with you.
Great to be with you, GC. It is great to be here with the Not Your Average Investor Show family. As we like to say on the show, if you are looking to find out about owning rental properties and investing in rental properties, you're in the right place. If you are looking to find out about the best property management practices for a long-term rental income property investor, you're in the right place. And if you are just simply looking for an edge in the magma hot Jacksonville real estate market because you're a real estate professional and you want some opportunities for you and your clients, you're in the right place. The next place to go is chatwithjwb.com. And the next place we go right after that announcement, guess what it is, GC?
What's that?
The roll call. You ready?
Hey, yo.
Lee Bishop, good afternoon, ladies and gentlemen. Carl Thompson, good afternoon, everyone. Chris Gonzaga, hello, everyone. Greg Stone, howdy from New Jersey. Dean Curry checking in from Ohio. Welcome, Dean. Jen Filzen, good morning, JWB family from the beautiful Monterey, California Peninsula. Alejandro Lopez checking in, good morning from North California. Lydia Filzen, a Florida legend locally here, a well-known author. Welcome, Lydia. Good to have you in here. Also, Jen Filzen's mom. She's known for both of those things. Drew Barnhill checking in from Atlanta. Good afternoon to you. Drew, John Henning, good afternoon. Hervé Francois from New Jersey.
There you
One
go,
shot
buddy.
to get it right.
Attaboy. You were practicing this entire week, weren't you?
I was sitting in front of the mirror going, Hervé. So I think I got it right this time around. Who do we got? We got Medj is back. Medj Garcia, welcome. Rosalind Riley from Murrieta, California. I know where that is, Rosalind. I used to live in the 951 as well. Good to have you here. Miguel Angel Sanudo. Hi, everybody from Spain. That's right, Lydia. You're a legend. You're a published author legend. Nadeem Shah coming in from the West Coast. Good morning, Nadeem. Good to have you here. Love the roll call. Love having everybody here. As most of you know that come back over and over with the Not Your Average Investor Show family, this is an interactive show. Two ways to interact. One is the chat that you already see blown up. Little trick in the chat that sometimes even our most seasoned family members overlook, and that is that when you chat in the chat, there's a little box above it that says host and panelists, and it's defaulted only to talk to us. If you want everybody else to see it, you got to change it to everybody. Jen Filzen, looking at you as the veteran that just made that mistake, but you got it. She did it again. It happens to everybody, Jen. Don't worry about it. And second is, we're going to go through this case study. This is put together for you out of popular demand. So we want you to get the most out of it. And we want you asking all the questions that you want to have asked here so that old genius concepts GC over here can explain it to you. So best way to do that is to pop open the Q&A box. It's a separate little box from the chat that populates right in front of my face so I can't miss it and I won't go cross-eyed looking for it. Sorry, Bazooska. Checking in from San Diego. Welcome. Sorry. Use the Q&A if you want the question asked on air, asked from GC. We'll explain it the best we can, and we can always get into further dialogue. Before right now, Greg, I think we've got a question to answer that seems like people have been asking. And we say that this is a audience-driven show. We hear you loud and clear. What is the question that you're hearing loud and clear right now, GC?
Well, the question is, hey, listen, the market value has gone up tremendously over the past 1 year, 2 years, even 10 years if you go back in Jacksonville and in most markets out there. So people are sitting on equity, and equity has been rising at a rapid pace, a pace that they weren't anticipating, right? If we go back to why we buy rental properties, it's not that we're expecting year-over-year appreciation gains of 15% like we've seen in Jacksonville. So now that we're sitting on this equity, what do? Should we sell? Should we hold? What should we do? We hear this question often. So the point of this show is to delve into that And I have an awesome case study. Just going to dig right into the source of the question. We're going to be able to show. It's like, what's that thing where I saw a road in the forest and I chose one path or the other path? Was that Emerson out there, right?
Robert Frost.
There we go. Robert Frost, right? That's what we're getting into today, right? Which path should you take? We're going to be able to put some real numbers to it. A real client case study for JWB. I think it's going to illuminate all of us as to the right path for this client and maybe for you too.
Why don't you prepare me so I can read this poem live on air here, Greg? You know I like to read stuff like that. I think it's two roads diverge in a forest, and I took the road less traveled, and that has made all the difference. I believe that is how the poem goes.
Yeah, something like that.
Off the top of the
I think
dome.
my
I don't
description
know.
was a lot better.
Bill
than
Shields
yours.
in the house. When I started this, amigos, welcome, Bill Shields. Not to cut you off there, Greg. I got excited when I saw him. Rosalind Riley is also back. Welcome, Rosalind. Good to have you. Rosalind, you're only talking to us, hosts and panelists, so Jen didn't get to see you saying hi. Hervé, also Jen doesn't get to see you, so you got to change that little thing. And Lydia fills in calling me a literary legend. Game, respect, game, Lydia. All right, GC. So we got this awesome case study, Joe Dela Cruz, past star. That is Leslie Wilson here from Denver. Beautiful, beautiful part of the country. Maria Lazo from Jacksonville. Welcome, Maria. Good to have you. So we're going to go into this case study of Joe Dela Cruz, past show star, good looking fella that's been on the show and he's contributed to this and he's been investing for a long time. Before we go into the nitty gritty, why don't you kind of, when you're looking at your returns on investment, when it comes to rental income properties, let's establish a baseline for me and my friends here of understanding the five. Can you talk us through the 5 profit centers real quick?
Yes, and it starts with understanding these 5 profit centers and how they interact over time is going to help you decide what the best thing for you to do is if you're faced with this question. But if you don't understand what 5 profit centers there are in rental property investing, you're not going to know what to pay attention to. And so few investors actually have a grasp of all 5. But we're going to start with all 5 here. So number 1 is the one that most people focus on, which is your net rental income or your positive cash flow, right? That is the money that is left over every single month. The rental income comes in, the expenses go out, what is left over? And think risk mitigation there. When you have something that's paying for itself every single month, that's an asset. That is the number 1 profit center, net rental income or positive cash flow. From there, we go to tax savings, right? This asset class has tax advantages that you can't find in nearly any other asset class, and they're available to all of you out there. It's not only if you meet certain criteria or characteristics. So you have the ability to defer taxes on income just simply by how this asset class works. So tax savings, the second profit center. The third profit center is your principal pay down. This is this wonderful feeling. If you buy and hold real estate for long enough, you're gonna wake up one day, you're gonna check into your bank account, you're gonna go and see what the mortgage balance is on the property. You're gonna expect it to be $100,000. You're gonna go and look, and it's $65,000. And that's $35,000 of equity gain. And who gained that? Your resident gained that for you. You gained it, but your resident did the hard work. Your resident paid the loan off for you. And that is a wonderful thing, no matter what the market value does, right? No matter if the property goes up in value or it goes down in value. You know, I think about a recent show where we did a show with Tim Hicks, who is a great client, works for a national home builder. And he said point blank, listen, I went in with all the best of intentions on rental property investing, but at the end of the day, I knew that my resident was going to be paying my loan off for me if I held on long enough. And that's why it made sense to him. Well, he's talking about principal pay down as the third profit center there. The fourth profit center is home price appreciation. That is what gets the most headlines, especially in a market like this. But rental property investors really fail to understand how to evaluate this. When can you count on it? When can't you count on it? But there's no denying that home price appreciation is impactful for your overall return on investment. In fact, out of all the profit centers that I'm going to be talking about today, home price appreciation is the big one. If you can nail that, that is going to have the greatest impact on your overall return on investment over a full market cycle. And the fifth profit center, one that is just so sneaky impactful, something that is getting more and more buzz lately because of the inflationary environment that we are in and maybe in for a while, is the fact that real estate, the rental income properties, are a hedge against inflation. That means that historically, as the price of goods and services continues to go up, the price of rents and the price of home prices tend to go up at a similar rate. And so that's a hedge against inflation. When you invest in paper assets, it's not a hedge against inflation, right? It can do whatever it's doing based on cost of goods and services going up. The stock price can go up or down and whatnot. But in rental properties, generally what you see is that rents and home prices tend to go up with inflation. And the super, super amazing thing about inflation hedging is if you couple that with smart debt. If the asset, the hard asset that you have that goes up in value with inflation is a hedge against inflation, if you have smart debt on that, that debt cost stays the same. So as the money that you're earning tends to go up, the debt cost stays the same, and you get to ride this inflationary beating wave. And Pablo knows a lot about riding waves there, brother.
I'm learning every day more and more about riding waves. I like this inflationary beating wave. Might be my favorite that I've been added to my repertoire of wave riding in the last year. GC, I want to break down kind of, you mentioned the 5 profit centers: cash flow, tax savings, principal pay down, home price appreciation, inflation hedging, right? All these profit centers are not created equal. You have a chart here that you have shared with me that I want to share, and I want you to kind of talk through why these are not created equal.
Yeah. So I love how we can just visually show how impactful certain profit centers are. I think this is one of the most misunderstood concepts in rental property investing. But what we're showing here is that the percentage of total return on investment broken down by profit center. And we're assuming these properties are purchased with smart debt and they're held over a full market cycle. So what you see here is, I'm not very good with colors, right? We're going to start there, Pablo. I'm going to need an assist. But the one that has 12%, what color is that? Blue?
That's JWB blue.
JWB blue. There we go. That is cash flow. That's your positive cash flow, your net rental income, 12%. Tax savings. What color is that, Pablo?
That is more like a midnight blue, very dark blue.
There we go. Midnight blue. I like that. I feel like that's like Lego Batman style blue, right? Been listening to a lot of Lego Batman with my kids, watching a lot of that. All right. So we got 9% for tax savings, right? So a little bit below cash flow, 9% of your overall total return on investment associated with tax savings. Principal pay down to the next one. Was that like a greenish, grayish?
That is a gray.
Gray. There we go. Principal pay down, what Tim Hicks was talking about as far as your resident paying your loan down for you and you being the benefactor of that, it's about 15%. Higher than tax savings, higher than cash flow. And then the big one here, what is that, red?
That is red.
Gosh, red, symbols royalty, right? That's because that's the king when it comes to your total percentage of ROI broken down over a full market cycle. Home price appreciation accounts for 64% of the total return on investment over a full market cycle. And this assumes only 4.3% home price appreciation per year, which is the historically accurate average for the Jacksonville, Florida real estate market. So what jumps out to you there, Pablo?
Well, it's the predomination of the home price appreciation bundle. It seems like it's more than all the other profit centers combined.
Well, you're right about that. So wouldn't you assume that when most rental property investors are coming to JWB or going to their own way of buying their rental property investing, wouldn't you assume that their decision-making would line up with these profit centers and their breakdown?
I would assume that those that buy here with JWB, it does line up with their breakdown, because I know that the Jacksonville market happens to be the positive cash flow, high growth for appreciation market. But I know that anecdotally, when I talk to people about rental properties, they're talking about monthly cash flow.
Yeah. You would be surprised to know. And when I was on the phones, right, early on in our career, when I was working with investors, right, or our sales team has taken over a lot of those conversations with us for our clients, right, I would just talk to clients all day, every day, or talk to new potential clients. And they'd say, I don't want to talk about home price appreciation. I don't want to talk about home price appreciation. I just want to focus on cash flow. I just want to focus on cash flow. And when you put it like this, right, if you only make decisions based on cash flow and you don't pay attention to the other profit centers, you're missing almost 90% of the return on investment that this asset class can provide for you. Right? It makes no sense to put blinders on 90% of the value of an asset and to make a decision on 12% of it. right? But that's what a lot of rental property investors do. They just don't know the nuanced way to look for cash flow, to understand that it's there, but use that as a threshold and then look at these other profit centers. And the biggest one is home price appreciation, right? So the goal here is for all investors to at least know why you're investing, right? Because if you know why you're investing, you can make better decisions. You can profit more handsomely given enough time.
Couple of questions here. And we got a couple people that are chiming in. Lee Bishop, Roger Evans has kind of figured this out, right? There's only 4 profit centers here, right? Where is inflation hedging here?
Inflation hedging is one of those profit centers that it's hard to define, right? So I don't put it in here. I focus on what's clear and simple and easy. That's just why I didn't put it down in the percentage of ROI broken down by profit center, right? So, if you're inflation hedging, your rent's going up or your prices going up tied to inflation is already, it's already in the home price appreciation category here, and it's already in the cash flow category here. So you would kind of see that in those categories. You could also make an argument that principal pay down is easy to pay down because, over time, your inflation means that as your rents and your prices go up and the debt stays the same, it gets easier to pay your loan down. So it's all kind of included there. I don't separate it. It's a little bit ambiguous. Just know that it's there, right? And it's included in really all of these other profit centers.
All right. 2 more questions. One from Miguel Angel. He asks, how different would this be if the graph was purchased in cash?
Be very different. The home price appreciation would be less, right? It'd be a lower percentage there. So that just goes to show you why, when you can master smart debt, you have the ability to increase your return substantially while also mitigating risk. But yeah, it's a really good point. Your home price appreciation percentage would be much less if it was a cash purchase.
Got it. So home price appreciation would be less. Principal pay down wouldn't be there because you wouldn't have principal to pay down.
Mm-hmm.
Cash flow would be higher, right? Because you don't have a mortgage that's cutting out of your cash flow.
Exactly.
And tax savings relatively equal?
Tax savings would even be lower because one of the beautiful things about taking out smart debt is that you have less cash flow, which means that the tax write-off, is able to write off more of the cash flow for you. If you buy in cash and you have more cash flow coming in, your tax savings is only going to be able to account for a fraction of your total income coming in. So you will still have a tax burden from the rental income, unless you have some other tax strategy.
All right. And we got Aloha Zach Correa, who just checked in to great fanfare. He says, I do believe now inflation is becoming influential in financial strategies. And for those who believe in an increasing inflationary environment, hard assets, real estate, and leverage, paying down loan with cheaper future monies is a great strategy, which seems like, as usual, we agree with old Zach over here. Miguel Angel also has a follow-up question just asking, do you have studies of how your ROI follows your predictions? I think that might be a good future show, right? Like maybe take a couple case studies and show the old under promise, over deliver via case study. I think
I love that. I love that. That would be fantastic. So we can take some actual properties and see how they have performed. We've done that a few times with some of the clients and guests that have been on the show. So that would be wonderful. We'll definitely do that.
Yeah. And Hervé has one more clarification. How about for a non-recourse debt? Can you kind of give like a redistribution of this graph real quick?
Well, sure. So for non-recourse debt, your cash flow is going to be just about break even. So that percentage is going to be very small, right? Your tax savings is not going to be there because your tax savings is assuming that you're getting these extra tax savings from depreciation of the asset. And if you're buying with non-recourse, 99 times out of 100, you're going to be buying in a retirement account. And when you buy in a retirement account, you already have all those tax savings because it's already tax deferred or tax free. You don't get additional depreciation tax savings. So you would wipe out the tax savings component there. Your principal pay down would be higher. It would be a higher percentage, right? Because you have a higher loan amount. And actually, I haven't thought so much about that. Depends on how much you're putting down and depends on what the interest rate is. So can't think off the top of my head on that one. And your home price appreciation would be lower than conventionally financed, a smaller part of the pie than this, but higher than cash. And the reason is because you get to put 50% down for non-recourse financing.
There you go. And the chat's going nuts right now. Drew Barnhill and Lee Bishop talking about these pluses and minuses and whatnot, and Zach adding in there. So great stuff from the JWB fam. Last question. But Greg, isn't home price appreciation purely speculative? I thought I can't count on home price appreciation.
Gosh, that's such a wonderful question. Who asked that question?
It was me.
It was you. Oh, okay. All right. I didn't know if it was our friend Anonymous Attendee from France.
I would do a different accent because that clearly wasn't French, Greg. So
You're right. That wasn't. Yes. So home price appreciation is so misunderstood. You know, if you went back to 2001 to 2006 and you asked somebody if home values always go up, they'd say, absolutely, home values always go up. Right? We had the chairman of the Federal Reserve who said that home values always go up back in the day. Right? That was the thought process. And then if you ask anybody after 2007, 2008 who owned rental properties, do home values always go up? Of course, the answer is no. We, experienced the Great Recession and home values dropped 35% in a span of 3 or 4 years in Jacksonville and across the country. And so what we have learned is that there's not an always and a never component to this. But if you would ask anybody now who's investing, should you count on home price appreciation going forward? Most people say, I'm not going to count on it. I'm going to put these blinders on. I'm not going to pay attention to home price appreciation. And as with most things in life, it is not, you can always count on home price appreciation. And it's not that you can never count on home price appreciation. The most savvy and successful investors in general know it's something in between, right? So in home price appreciation, the key here is longevity, because real estate is cyclical. And what happens is over time, if you go back and look at your market and you give it a full market cycle, which is known to be between 10 to 20 years, your home price appreciation rate is largely very similar to what it was in the last 10, 15, 20-year segment of time. And so when you say real estate is cyclical, you're already saying, well, I know there's a cycle component to this. So if I know how it performed from a home price appreciation perspective over the last cycle or last 2 cycles, well, I have a pretty good idea of how it's going to perform over the next cycle. So home price appreciation is not something that I can buy today and know that I'm going to get appreciation tomorrow or a year or 3 years or 5 years from now. But if I'm committed to a 10 to 20 year hold, it's like I have the answers to the test. I can count on home price appreciation. And that's why I have held on to my rental properties for 15 plus years now and plan to hold on to them for a lot more. And that's why I advise clients to hold on to theirs as well. It's because if you don't commit to the buy and hold for the long haul, then you can't count on it. Then you're missing out on the biggest profit center if you're buying with conventional financing.
Yeah. And just to prove that point, we've shown this slide a bunch on the show, right? But this is the idea that if you look from 2001 to 2021, you have this very smooth graph of 4.3% home price appreciation. And, that is going full market cycle through the Great Recession and out the back and where we're at right now, right? So, what I'm hearing from you, Greg, is number one, it feels like the biggest place that you can make the most money on rental income properties is home price appreciation. 2, feels like all 5 of these profit centers seem to get better with time. And the question that's out there right now is, well, what if I've gotten the best of the home price appreciation right now, right? Like we've just had this increased home price appreciation. Isn't it time to cash in on that and, cash out and do whatever else I need to do with that money and maybe put in other classes, maybe reinvest in the market, right? But like, what should I be doing right now? If I've held a home for some time, I just went through that nice little upcycle of like 20% home price appreciation that just happened. Should I sell or should I hold?
Well, that is the topic du jour today. And there's not a one size fits all answer, but what I'm going to show you here in this case study is real life, somebody who had that exact same opportunity and either decided to go in one of the diverging paths or the other diverging path. And we're going to see how the numbers played out. And then we'll wrap up our discussion here today by talking about pros and cons of each approach.
Got it. All right. So let's start. We teased it. We said he was a good looking fella. Joe Dela Cruz up here on the screen. He's been a guest on the show, bought his home, 7320 Bamberg Road 32277 in 2014. Purchase price of $94,860 would be awesome to find a home at that price right now. Mm-hmm. Put a 20% down payment of $18,972. Talk us through it, GC.
Yeah, it's just one of the most amazing things after doing this for 15 plus years and having these wonderful client relationships and actually tracking all of the data since 2011, it's not an enigma. It's not just that we're going to be able to share ideas from an ivory tower or take industry averages or whatnot. We're going to look at this real life example of Joe's property, which he purchased in 2014, when the market was going up in 2015 and 2016. And then we're going to be able to look and say, well, what was the right move for Joe? So it's a great segue here to looking at this report. This client ROI, this is a part of Joe's client ROI report, which is available to every JWB client, and that no other turnkey provider in the country that I'm aware of has this type of reporting. And what we do every single month is we look at what is your return on investment, what's your net rental income, what's your tax savings, your principal pay down, your total return on investment. We break it down even farther. I just didn't want to get all knee deep in all of the numbers and figures here, but we are able to see how much maintenance cost, how much rental income come in, gross rental income, what property taxes did we have, all of these things. So we're able to produce this. So now let's look at where Joe was in 2014. He bought the property beginning of 2014. He had an entire year go through. He had a great year. Right? His return on investment just from the rental income in 2014 was just over 22%. And the way that you get that is you calculate the net rental income, which means that we took into account all of his maintenance costs, any vacancy costs, any tenant placement fees, take all of that, property taxes, insurance costs, everything, take it all into account. And he was left with about $2,600 in net rental income. He also enjoyed tax savings, right? That other profit center and principal pay down as well. And so his total return on investment of things that just affect his cash flow, not talking about home price appreciation yet, was about $4,800. And of course, we divide that by his initial investment, and that's how he earned over 22% on his money in 2014.
Now, this
Same
is
thing for
22%.
2015.
This doesn't have appreciation included, right?
Correct.
Okay.
This does not have home price appreciation included.
So then talk me through this. So he's in it for 2 years. He makes 22% and 22%, making real good money. At that point, I'm assuming that he's thinking about renewing the tenant or not, and therefore paying for a turn. Is that kind of like the headspace that Joe gets into in 2015 and making the decision?
No, I wouldn't think that's his headspace because, for us, it's all about signing and re-signing long-term residents. Joe may have had a 3-year resident at that time. And so his headspace was not, well, should I renew this person? And I don't know what Joe's headspace was in 2015, right? I'm using the real numbers here, but I don't know what Joe was thinking at the end of 2015. He probably wasn't thinking whether or not to sell or not, right? But he could have. And many of you are out there after owning a rental property for a year or two, and you are saying, well, just because I enjoyed high appreciation now, maybe I should change my strategy. Maybe I should just take the profits. Is that the right move? Some of you may be saying, I'm deathly afraid of maintenance costs. Right? I know that long-term, over a long time, rental properties are going to break down more, right? That just makes sense, right? If you hold on to it for 10 years, eventually things are going to break more than if you held on to it for 1 year. And some of you are so concerned and afraid of, it's the combination, should I strike while the iron's hot and sell this rental property because I enjoyed a home price appreciation that I maybe wasn't expecting? And do I make sure that I get out before this upcoming maintenance cost comes down, right? Or maybe the resident turns over, or maybe my roof goes out and you're concerned about that for one thing or another. That's the headspace that all of us in this case study should be at right now.
Okay. So that's where we're at here, right? We are right here inside Joe's headspace, making this decision. If he sold at the end of 2015, it would show this lifetime net rental income of $5,254, lifetime tax savings of $1,862, lifetime principal pay down of $2,493, home price appreciation of 10 G's, right? Like that's now we're including home price appreciation in there. Mm-hmm. And then closing costs of $10,500, total return of $9,109, total ROI, IRR of 7.3%, which, quite frankly, man, if I make 17% in the stock market, I'm feeling pretty good about it, right?
It's pretty awesome.
So right? It's a nice little return.
So, and many of you would look at what your returns are right now after holding rental properties for maybe a short period of time and seeing some home price appreciation. And you're saying, well, my returns are pretty good. And I think that would be the same conclusion that Joe drew, right? Better returns than he expected when he gave us his money back in the day. And if You could tell me that I could earn 17% on my money year over year for the next 2 years, and a certain investment, sign me up all day, every day, and twice on Sunday, right?
Yeah. I mean, people do that for much less than that, right? 10%.
There you go.
Right?
There you go.
So, all right. So where do we go now? Let's check out if you would have held on. Let's look at 2016. Talk us through this.
All right. So, well, before we show that, let's get the headspace, right? We talked a lot about what if, right? We know that we've had significant appreciation now in Joe's mind. And in our minds, we may be saying, well, what about this maintenance cost that at some point may be coming either from a property turn or a roof going out or an AC going out? Does it make sense for me to get out now to avoid that, right? Well, guess what happened for Joe in 2016? This is why this is such a good example, is because Joe had one of those moments in 2016. He had a really tough year for maintenance costs. And I love showing all of you what it really can feel like to own rental properties. Joe had a turn on his property that was over $6,000. He had over $6,000 of maintenance costs in 1 year. Pablo, is that normal?
Not normal.
Not normal. Can it happen?
It can happen.
It can happen, right? And it happened for Joe in 2016. The first year in this fictitious situation that we're talking about, the first year that after he made the decision to hold on in this example. So let's take a look at what the numbers show.
Let's take a look-see here.
So here you can see 2014, 2015, rock star years. 2016, negative 15% annualized return on investment. Again, this isn't taking into account home price appreciation. This is just from the things that affect his cash flow, right? But you can see that we had some splaining to do, right? We had some splaining to do.
You have some splaining to do.
Joe was not happy. We were not happy. But again, this all starts with proper expectation setting with Joe on the way in. He was prepared to handle things like this. And, we just had a large turn. So his gross rental income went down. You can see it was 12 or 13,000 the year before, and it was 9,500. Why did that happen, Pablo?
Vacancy, right?
Yeah.
Less a couple of months without rent.
Yeah. This is a tough situation. It's a longer vacancy than we normally would have, right? I love showing you guys this real information. This is what it's really like to own a portfolio of rental properties. This will happen at some point. And of course, there will be a lot of other examples, just like 2014, 2015 for forever. But it's good for you to be able to take the highs and the lows. Maintenance expense over $6,000, negative 15% return on investment. Joe continued to follow the strategy of buy and hold for a full market cycle.
All right. He continues to hold, as it says here in this headline.
So fast forward to 2021. I put the numbers for real time today, how it would shake out, because Joe, who experienced 2 great years and significant home price appreciation after those 2 years, continued to hold, maybe was concerned about the big maintenance cost that might come down the pike, was hit with it right in the next year, and then continued to hold all the way through 2021, which is now, 7 years of home ownership. How has it played out? And what you're seeing is the value of all of these profit centers continues to get better and better with time. Net rental income now on that property has gone all the way up to $12,000, right? Remember, we started at $5,000 after 2 years. We then lost 6, and then we came back, right? So significant rental income. And you know why that is, right? We get long-term residents. Generally, they stay 4.5 years on average. And that was Joe's experience right after 2016. Since 2016, when that new resident came in through today, it's been 1 resident, and the returns have been very similar to 2014 and 2015. So $12,000 of net rental income, $9,000 of tax savings. This profit center continues to get better and better over time as well, because as your rents continue to go up and you have that income coming in, higher income, the amount that you're able to offset with the write-offs from depreciation, that's the amount of income you're able to offset. And when you start, you don't have enough income coming in to offset the full depreciation. But as you continue to get more and more income over time, as your rents go up, because it's a hedge against inflation, you're able to write off the full amount. Well, there you go, $9,000 in tax savings. That tax savings profit center continues to get better and better over time as well. Principal pay down also gets better and better over time. Pablo, have you ever looked at the amortization schedule of your loan?
No.
I don't know. If you're bored on a Friday night and you want to sit down, Martha, and have a good time, I mean, I'd say it's probably a good thing to do. I mean, just that's what I do. But no, if you're looking at amortization schedules, right, the amount of principal pay down in your first year that your resident is paying off for you is less than the amount in your second year. And that's less than the amount in your third year. The longer you hold on and the longer your resident pays that loan off for you, the higher the incremental gain of principal pay down. Again, your profit centers get better and better with time. Has home price appreciation gotten better with time since Joe has continued to hold?
Oh, yeah.
Yeah. So that $10,000 of home price appreciation is now $70,000 of home price appreciation. And as we expected, that is the most significant contributor to his overall return on investment. You can see it here. Again, if you're not paying attention to home price appreciation along with the other profit centers, you're missing the boat. What if Joe just didn't even think about the other 5 profits? What if he only made decisions and only wanted to earn his returns on net rental income? Do you think he would have made a mistake in buying in Jacksonville with JWB in 2014? He might have gone to some other market, right?
Correct.
Yeah. Or some other team he didn't focus on maximizing all 5 profit centers. But there's one thing I want to point out here: closing costs, commissions, and et cetera, right? The market value of Joe's property right now is $165,000. So the closing costs, commissions, et cetera, easy way to just take into account the illiquidity and the costliness of selling an asset. Just take 10% off the cost. Take 10% off the sales price. You're going to give that back when you go to sell your property, right? 6% for a realtor, 2% for your holding costs, 2% for your selling costs and your closing costs and all that good stuff. Just 10% right off the bat. So you're given 16.5 back when you go to sell. You know, I'm assuming he sold this year. Think about the impact if you only held the property for 2 years, right? This is why when we talk to clients, we want to make sure that you're committed to a buy and hold strategy. It's not for any other reason other than to set you up for success. Because even if you get significantly higher appreciation in the first 2 years than you were expecting, your properties are going to be priced at, 165, 200, 250,000. You're going to give $15, $20, $25,000 back just in disposing of the asset, right? So that's why this buy and hold continues to get better and better over time. The impact of closing costs, commissions, et cetera, becomes less and less the longer you hold on to the asset. Many people miss that.
Yeah. And explained in dollars and cents, it was 10 years ago, it was $10,000 already, and it's only increased by $6,000 over the last 8 years, as opposed to having already, so it's only increased by, that $6,000. Whereas before you were already having to lop off that 10 right off the bat, right? So that appreciation that's happening and the extra net rental income that you're getting more than makes up for the delta in increased closing costs, right? It's basically what you're saying.
Exactly.
Got it.
Exactly.
Got it. So if you were to sell today, he would have had a total return of $88,775 and a 39.7% IRR, which compares to that 17% is more than double, right?
Yeah.
So more than double that. And I forgot what the total dollar amount would have been. It would have been $9,000.
Yeah.
Right.
So let's go back to 2015, right? He knew it was in a good spot. He had a home price appreciation, just like many of you are in a good spot. If you've been investing in Jacksonville, been listening to JWB, especially over the last few years, right? You're in a good spot. But what is the best thing for you to do? What's going to produce the best risk-adjusted return on investment for you over the next 3 years, over the next 5 years, over the next 10 years? It's pretty clear. For Joe, the best thing for him to do was to hold. Even if the worst case scenario in his mind, this fictitious maintenance cost that may or may not come up, even if that happens, the best thing for Joe to do was to incur that maintenance cost, continue to hold, let these 5 profit centers get better with time. And now in 2021, he's earned a 39.7% internal rate of return. That return on investment, to have your money earning, call it 40% year over year over year for 7 years. I mean, that is, and to do it in a risk-adjusted way where you can mitigate risk, where you can have positive cash flow coming in. I keep going back to like what made me leave from my conservative job in corporate America and give it up to go and try to buy as many rental income properties as I could when I was 23 years old, it's because I saw this. Like I saw the potential for me to do this conservatively, but also be able to invest in a market that does historically grow over time and be able to earn 20, 30, maybe even 40% on my money.
Yeah, and when you say all this, GC, I think of a couple of things. I think of, what would have happened if you owned Amazon stock in 2009 and decided to sell it when it was if you owned it from, I don't know, like from 2000 to 2010 and decided to sell it at like 500 versus it going up to 2000. So it's kind of that same decision of, do I hold or do I sell? Right. But then in the Amazon piece, it seems like company by company, there's like a higher variability of how much it can go up, but there's also a higher variability of like how much it can go down, and also the moment in time in which you exit Amazon in relative to wherever you're at in life is much more variable as well. Is that kind of the right way to think about it?
Definitely. I think those investments are really worlds apart, right?
Okay.
The investor who's investing in Amazon versus the investor who's buying and holding for passive income. And, they're really just worlds apart for me, right? If we go back to why you invest in rental properties, right? The positive cash flow, the risk mitigation, right? You really don't have that with the Amazon stock, right? The ability to be able to use smart debt and leverage in rental property investing. You don't have that in the Amazon stock, right? The high upside, you definitely do, on the Amazon stock side. But that to me is, equities really are, in my opinion, if you can't look at the fundamentals of an equity and have it make sense, like why it's going up in value or why it's going down in value, to me, it feels like Vegas. And there's, and you can gamble, right? Like that's not a bad thing. But if you're counting on this income and if you're counting on this asset to be there for you in 10 years or 20 years, that's not that bucket of money for me and for most clients. There's a different bucket of money for the Amazon investment.
Okay, that makes sense. So then let's talk about, we have this comp here of him holding on versus selling, right?
Mm-hmm.
That is assuming that we've had this extraordinary home price appreciation. Talk to me about what would have happened if it would have just been 4.3%.
Yeah, I figured that would be a really good question. So again, buying and holding for a full market cycle, we're getting close to 10 years for Joe, and he bought in 2014. So we're getting close there. But for you, if you can buy and hold and be committed to a 10 to 20 year market cycle, really good chance that you're already going to know what your home price appreciation rate is year over year, right? And that's a lot, right? That's 4% a year, and you only put 25% down. That's like you knowing that you're going to get a 16% return on investment year over year just from the home price appreciation. And it's not like you have to be really good at this. You just have to be in for a long time. All right. So let's go and let's look at those numbers again, but let's bring that home price appreciation down, right? We've been experiencing about 8.8% home price appreciation in Jacksonville during the time that Joe has been investing on this property. But let's bring it down just to 4.3% and see what the numbers are.
There you go. So this is the exercise with the 4.3%, right? So now it went from, we were at 39% in buy and hold. It comes down to 35% buy and hold, right? So there's a little bit of a difference, but it's still a significant IRR, which still greatly outpaces that initial 17% if he would have held on to it for only 2 years, right?
Exactly. Right. This is just showing you that all of those profit centers get better and better with time, right? Home price appreciation is significant. It's still the biggest profit center, but the longer you hold, those profit centers continue to get better and better with time. And the downside of the illiquidity and the cost of selling also gets better with time. The downside gets better with time there too, right? And so ultimately, this should really stand out to most folks that even though he incurred the worst case scenario that he was talking about there, and he still held on and values did not go up as much as they actually have, he still would have made twice as good of a decision by buying and holding than if he had sold prior to the maintenance cost when the market was high earlier.
There you go. So took a beating the following year, but by buying and holding, it erases everything, right? It more than makes up for everything.
Mhm.
Zach Correa's got a good question here in the Q&A. What is a good ROI to look for right now when investing in rental properties?
Well, so let's talk about the return on investment, that the way that I like to portray expected returns on investment. If I'm making a decision, I like to think about it in two buckets, like risk mitigation bucket and then upside bucket. Risk mitigation to me is the things that I largely can control. Your net rental income, your tax savings, and your principal pay down. Largely we can control those things, or an effective property manager can. So right now the market is bearing between 6 to 8% in Jacksonville for return on investment on that, things that we can control, right? And then if you're committed to a buy and hold strategy of 10 to 20 years, a full market cycle, then you can count on home price appreciation. If you sprinkle that 4% home price appreciation and you use smart debt, that 6 to 8% return on investment from the things that we can control balloons up to over 20% returns. So, for all of you out there, I would focus first on making sure that you're working with a rental property or a property management team that can deliver somewhere around, let's call it 6 to 8% returns, taking into account net rental income, principal pay down, and tax savings. And then also look at the market that you're investing in. Go back and do the research, or ask that team that you're thinking about investing with to do the research and to see what their average home price appreciation has been in their market since 1991. Spoiler alert, you're not going to find many cash flow markets that have the rate that Jacksonville does, which is why so many investors are attracted here and why I have my own assets here. And Jacksonville's 4.3%. It's very common to be in the 2s or low 3s in other markets. And again, if you're holding on to an asset for 10 years, 20 years, that 1% difference or 2% difference adds up to hundreds of thousands of dollars in returns that you'd be leaving on the table if you don't pay attention to home price appreciation.
Got it. So there's a middle step here though, right? Like there is a way to, if you've held on long enough, you have this equity, you've done well, there's a middle step that isn't selling your property, that is more how to leverage all these benefits, right? And that is what kind of Drew Barnhill said here earlier, don't sell, refinance and buy more properties, right? You want to explain what that is?
Yeah, because as an investor, we have to understand that our return on equity is zero if we don't do anything with it, right? Equity, if you're just sitting on equity in your home, it's not doing anything for you. That is an asset that could be used to produce more positive cash flow, like Drew is hinting at. And so return on equity is zero if you're not doing anything with it. If you turn it into real cash that you can then go and invest, then you can increase your rates of return. So one of the ways to do that is through a cash out refinance. A cash out refinance is when you've got your original loan in place, you get a new loan at the new rates for today, which are way low, right? Interest rates are way low for today. And then that new loan pays off the first loan and can give you access to the equity that you've earned in the process. A cash out refinance today will largely be lent at 75% of the new value today. And so if you're able to cash out that first loan and then get access to the equity, you can then use that to buy other rental properties or do whatever you need to do with your life, whatever your life goals dictate, right? There are many investors out there that just have a strategy. They've bought assets. They bought and held assets for full market cycles for a long time. And their strategy in retirement is well-timed and executed refinances, right? Do you know how much income tax you pay when you access your equity through a refinance, Pablo?
I believe it's not a lot.
It's zero. That is not a taxable event. So if you want some amazing tax planning, right? Have an asset, held onto it for a full market cycle, and then strategically pull out the equity that you need to live on, you're not paying any taxes on that. Versus if you sold that asset and you don't have an effective tax planning strategy in place, when you sell, you have to pay capital gains taxes on it if you've held onto it for longer than a year, right? That might be $10, $20, $50, $100,000 that you have to give back in the form of taxes, right? So a cash out refinance is wonderful. Many times it can lower your payment as it is today because your interest rates are so low. It can give you access to the equity. So then that's real capital for you that you can then reinvest or do whatever it is that your life goals dictate. And when you pull that equity out through a cash out refinance, There are no better tax savings than that because it's access to your equity and it's not a taxable event.
There you go. Money that Uncle Sam won't mess with. That is all yours, and you can do whatever you want with, right?
Mm-hmm.
So as we go through this, we've gone through this case study, right? 2 years in, looking really good, can cash out, make some good money by all accounts, right? Like good investment by all accounts. Doesn't do it third year, takes a beating in kind of like what happens during time with rental properties. But by holding on, home run, just more than doubles the ROI, greatly increases the cash flow, greatly increases his options as far as, cash out financing and stuff like that of different things he can do that is non-taxable. So really maximizes his profit centers. So the question begs then, when is the right time to sell your rental income property, G?
Well, I think there can be a right time for every investor out there. There's no one size fits all answer. I think it comes down to a few different things. Number one, if your life goals change, right? If your life goals change, like example is people get closer to retirement. Some people make the decision that they don't want rental properties anymore because they're not sure about how they're going to pass those on to future generations, or they're concerned that it might be messy, whatever it is. Many of those things can be addressed and a plan can be in place for that. But some people, they don't feel that way. They would rather not have a rental property at that time. They've come to that conclusion. Or if the income that they need, if the income needs change. Like for example, we just talked about this percentage breakdown of total returns for Joe's property. You saw that largely that was coming from home price appreciation and all of the profit centers, right? The cash flow for Joe, if he was getting to retirement, might not be enough to support him. Now he does have other properties, but in that case, if you needed to get into if your life goals dictated that you needed to get into a high income producing investment that was higher than rental properties, then maybe it makes sense for you to sell your rental property and then put that into a different asset class. The only thing I would mention there is there are so many ways to do that within rental properties to get more cash flow that it's pretty unlikely that if cash flow for you was a major need, that we couldn't accomplish that while also holding on to the asset and making sure that you could benefit from all 5 profit centers. Like for example, Pablo, when we do the property of the week on Thursdays, you're very quick to point out that this cash flow that we get every single month when it's conventionally financed will do what when it's paid off, Pablo?
It is going to spit out way more cash.
Yeah. It's going to spit out way more cash. So with some strategic planning, many times rental properties can be that cash flow source. So, some people don't see it that way. Some people might say that their life goals and maybe being a little bit farther down the path and wanting to dispose of a hard asset and they want something that's more liquid, that might be a reason to sell rental properties. If that's important to you and you don't like any of the solutions within rental properties, maybe that's a reason to sell your rental property.
And to the point of having all these different options, right? Like we're talking about cash out refinances. We had Ken Moline on kind of at the end of last year, beginning of this year, talking about how he had run out of retirement funds and he was able to get to like $5,000 in passive income in his retirement real quick. Do you want to kind of just talk real through what that mechanism was, just to feed the mind of more options of things you can do with rental properties?
Well, absolutely. So buying properties in cash, as we've talked about, is one way to make sure that your income on the rental property is really high. Hard to get the same type of dividends anywhere else in the stock market or types of bond yields that you can get in rental properties that are purchased with cash. So many times if their life goals have gone from maximizing all 5 profit centers, which is usually like your conventionally financed plan, to income maximization, well, then there's a plan to pay off those assets and make sure that the maximum amount of income is coming in for those clients. So a lot can be done with the initial purchase and buying it with cash if that's important. And a lot can be done through strategic debt pay down over many, many years, which is what our team is here to help you out with. Many times that plan is put in place over 5 years, 10 years, 15 years, and we get to work with clients for that long. So that plan is in place by the time you get to retirement. You don't have to give up a wonderful asset just to accomplish cash flow like Ken. right? Ken was able to hold on to the assets and meet his cash flow needs there.
There you go. So multiple different ways to do it to get to those cash flow needs. Rental property investing provides multiple different options of doing it. If it is a hard and fast change in your life where your priorities change, that's when you look at it. But in general, holding on and continuing that kind of like flywheel of the 5 profit centers that feed themselves is generally the right move, right?
Well, yeah, but I got a couple other examples. I'm just trying to rack my brain, and I don't want this to always be, hey, listen, this buy and hold is 100% the way it is for everybody, right? We talked about one reason being if your priorities change. But, we all kind of live in our JWB bubble here where, this investment is meant to be very passive and it's an enjoyable experience. And we have our community here. Many of you have experienced that. There's a whole nother world out there of investing in rental property. So if I'm kind of stepping outside the JWB bubble for something that's a real pain point for investors out there that does make them want to sell, even if they understand they're leaving money on the table, it's because rental properties can become a pain, right? The experience can become poor. So if you are investing in rental properties out there and you're sitting on significant appreciation and you're working in a different market with a different provider, but at the end of the day, you're saying, listen, I don't care that I'm making more money here than I would in other assets. This rental property is a big pain in the rear, and I don't like the property manager that I work with. It's not going to matter to you. You're going to sell that asset even though you're going to leave money on the table because there's just an enjoyment component that is difficult to master in rental properties. So I think that would be another reason. I don't think it's all about return on investment. I think this is something that needs to be an enjoyable experience as we're all busy and have other things to do, right? If this is the thorn in your side, no matter what the return on investment is going to be, you're probably going to want it. So that might be a reason to do it. And I can certainly understand that one.
That makes sense. All right. Before we log off here, Maria Lazo has a question. Is there an Airbnb market in Jacksonville? Who was the guest that we had on not that long ago that talked about their Airbnb experience?
Oh, Bill Fox.
Bill Fox. Maria, if you want to go through either YouTube or in the podcast, wherever you listen to podcasts, and look for the Not Your Average Investor Show, look for the Bill Fox episode. That'll tell you all about that. But you want to just kind of say, is there a Airbnb market in Jacksonville, GC?
There is an Airbnb market in Jacksonville. Bill would be a good one. Just do some research. JWB doesn't offer Airbnbs, but I love the idea. And, I'm sure if you post something in the group, there might be others who have a significant experience with it.
That's right, Maria. So there's plenty of our community members in the group. I don't know if you're a part of it, jwbfacebookgroup.com. Post it in there. There's people that own both passive rental income properties and the more active Airbnb market that is a different experience. So good stuff putting this together, GC. I thought that was really well illustrated. It became, seeing the numbers, seeing the pie chart for me was a big one, right? Like really understanding how much more of the pie the appreciation part is. And then, I think that's a real kind of crossroads that everybody gets. It's a real path in the forest that diverges that everybody walks upon. And sometimes you take the road less traveled, which is, because you have a guide that tells you this is what it looks like ahead of the game, right? So in order to be able to really see it and notice that you can more than double your IRR, way outweigh any kind of like increased cost of closing costs, go really much higher on what your cash flow is, despite having a brutal year, the year that you had that you made that decision. I think that picture was worth 1,000 words, man. Good job with that.
Well, thank you, brother. It was fun putting it together.
Yeah, man. Good stuff. And I want to thank everybody that was here with us today. Alejandro's, he's logging off. Bill Shields is logging off. Lee Bishop's logging off. Jen, also Drew Barnhill. Chris is logging off here. Just thank you for being with us. Never falls on deaf ears the idea that you could take an hour out of your Tuesday and spend it with us here today. So that really fills our bucket. And we hope that you join us on Thursday for what we do on Thursdays, which is the JWB Rental Income Property of the Week. Oh, one more update before you log off. Jen Filzen and Lee Bishop are going to be hosting a meetup of Not Your Average Investors October 9th in Baltimore. So if you're in the Baltimore area, hit up Jen Filzen in the Facebook group, join us. You're going to have a little bit more time to join us back on the show and reconnect with Jen or whatever you got to do. But the next iteration of our live community meetups that Jen is pioneering, her email is jenniferfilzen@gmail.com. Cell phone is 408-833-9868. hit her up. If you're anywhere close to Baltimore, you want to hang out with two of the coolest people that are in our community, which are Jen and Lee, and I would assume Renee is also in there. So three of the coolest, and it's going to be great. It's Andrew Barnhill's asking October 9th, Drew. So in case you want to make that road trip, which you have already committed to making amazing road trips, so should be awesome. And that's it. I want to thank everybody for coming. GC, I'll give you last words, buddy.
Yeah, we really appreciate you guys being here. It's so fun to think about this becoming more of a just an organic meetup type of an environment for all of us, our community, continuing to take that, next baby step at doing that. We've had 3 or 4 so far, and they've just been really, really fun. So big thanks to Jen, Renee, and to Lee for, carrying the baton, and hopefully everybody here who tunes into the show every single week can come and join us live and in person. We appreciate you guys. We'll see you guys on Thursday. Thank you, guys.